Hi everybody, today we're going to be talking about the mechanics of monetary policy. Monetary policy is a policy that is implemented by the Federal Reserve Bank. If you borrow money for a house, for a car, whatever it might be, you're going to care a lot about monetary policy because monetary policy helps set the interest rate at which you will borrow at. So let's take a look here at monetary policy. All right, so monetary policy is central bank. There are multiple central banks around the world. The Fed is the central bank of the United States. You have the Bank of Japan, European Central Bank, Bank of England. It's their efforts to promote full employment, to maintain price stability, and to encourage long-run economic growth through control of the money supply and interest rates. So it's important to note that the Federal Reserve has what's called a dual mandate. They want to go ahead and create an economy that has full employment, and they also want to have low inflation. Right now, the Fed's target is about 2% inflation. So it's important to keep that dual mandate in mind when we're thinking about the Federal Reserve. They have two goals: low inflation as well as full employment. So there's an interesting little analogy here. The Fed is to a capitalist economy as a driving instructor is to a 15-year-old student driver. And you might remember back when you were doing you were learning how to drive, about how the driving instructor can actually can hit the brakes and can let off and get off the brakes when he's driving with a student. And so the Federal Reserve kind of does the same thing. The Federal Reserve can put the brakes on an economy when there's inflation. They can, by raising interest rates, and then they can go ahead and let the economy move again and push the economy forward when there is unemployment. They can do this by lowering interest rates, and that would encourage investment, and that would also encourage consumption. So there are a couple types of monetary policy. The first one is expansionary monetary policy. This is also known as easy money. This is going to increase aggregate demand. So this is monetary policy that is designed to counteract the effects of recession and to return the economy to full employment. Here, the money supply is going to go up. This is going to go ahead and drop nominal interest rates, which is going to encourage investment as well as consumption. So the important thing to think about here is that think about how with an expansionary monetary policy, you have easy money. There's lots of money in the economy, so money's cheaper to lend, and so that's going to drop normal interest rates there. You also have a contractionary monetary policy, and the goal of this is to lower aggregate demand. This is called tight money. So this monetary policy is designed to counteract the effects of inflation and return the economy to full employment. This is going to lower the money supply. When you lower the money supply, that's going to raise nominal interest rates. Think that there's not, and with a contractionary monetary policy, there's not as much money in the economy, so it's going to be more expensive to lend out, and thus nominal interest rates are going to go up. Next, I want to look at the three tools of monetary policy. We talked about with fiscal policy, we talked about how the Congress and the President can change taxes as well as the amount of government spending. Those were the two fiscal policy tools. Now we're going to look at the three tools of monetary policy. So the first one is the required reserve ratio, which we've already talked about at an earlier date, the discount rate, and then open market operations. So let's take a look at the required reserve ratio. This is a review. We already talked about this a little bit when we talked about multiple deposit expansion a few days ago. So the required reserve ratio is the percentage of demand deposits that must be stored as vault cash or kept on reserve as federal funds in the bank's account or with the Federal Reserve. So there's a certain percentage of deposits that these banks have to hold. Okay, that percentage is called the required reserve ratio. The required reserve ratio determines the money multiplier Remember, the money multiplier is 1 over the reserve ratio. So decreasing the reserve ratio increases the rate of money creation because there's going to be more excess reserves. Banks have more money they can lend out, so there's going to be more excess reserves. And therefore it's expansionary because remember, it's the more excess reserves means more loans, and that's going to expand the money supply. Increasing the reserve ratio is going to do the opposite. It means banks have to hold more money, which means they can lend out less, which means excess reserves, of course, there are going down. So this decreases the rate of money creation in the banking system and is contractionary. So changing the required reserve ratio is the least used tool of monetary policy, and it's usually held constant at around 10%.